You know that I love Roth IRAs. I've got a boatload of videos about them. I talk about them on the channel all the time. Here's the thing, you can actually have too much money in a Roth IRA. The reason why I love Roth IRAs and why I suggest them to so many clients is because you can take your retirement money and make it tax-free. You pay the tax on that traditional money to get it over into a Roth where it becomes tax-free. But here's the problem. If all you have is Roth money, you're missing out, because to get it there, you had to pay tax somewhere along the line, whether it was a contribution and it went in with post-tax money, or it was pre-tax money. It was traditional money that you paid taxes on to convert to Roth. And so if it's all Roth, it's tax-free, which is good, but because of the way our tax system works, you can have a certain portion of income every year and not pay tax on it. And so if you've already paid tax on all of your retirement money and you have relatively limited other sources of income in retirement, Social Security, things like that, you might be paying more tax than you need to. I did an example of it. I'm going to break this down for you. So if you're a married couple filing joint and you're over the age of 65, $28,700 per year is your exclusion. That's the amount of the standard deduction that you can have when you file your taxes. Now, Social Security does not count dollar for dollar as taxable income. A certain portion of it is not subject to tax. There's a whole calculation. I feel like I did a video about that. I'm not sure, but there's a whole calculation. Not all of it counts towards taxes, which means you can have some distributions from retirement accounts that are to be taxed, traditional IRAs, 401ks, things like that, to a certain level and still not have to pay any tax. You got the deduction when it went in, it grew tax deferred, and now you can pull it out in retirement and not have to pay tax on it. Important to note, I say it all the time, I'm a financial advisor, I'm not a CPA, this is not tax advice. Go to your tax person, but think about this when you're doing your planning. I ran a calculation. If you had $35,000 in Social Security income, married filing joint, over the age of 65, $35,000 in Social Security income, you could get a little over $23,000 a year out of a to-be taxed account, out of a traditional IRA as income without paying any taxes. The federal tax rate on that money was still zero because of the exclusion. So when you think about it in that way, if you've converted all of your money, you had to pay some tax to get it there in some form or another, whether it was, again, post-tax money or it was money that you paid to convert to Roth. And if it all lives over there, you're missing out, depending upon the makeup of your income, on getting some of that money out tax-free without having to pay tax to make it that way. If you're enjoying the channel, two things. One, subscribe, come on back, because if you do, you'll get notified every time we post new stuff. And then second, go on down to the links in the description. If you're in the process of planning for your own retirement and you've got some questions and you're looking for a sounding board, I'm happy to help. There's a link down there. You can see how that would work. The second big one is qualified charitable distributions. If you're charitably inclined, if you feel like you want to give some money to your church, your charity, you're able to do that subject to the limitations of a QCD. I just did a video about that. Not a popular topic, but it's an important one. You can get that money out of pre-tax accounts without paying taxes as well. That's a second way that you might be missing out if you've converted everything to Roth. So here's what I have to say. This is the short version. I love Roth IRAs. You should love them too. They're a good idea. Don't put everything into the Roth IRA. It's like the old saying goes, don't put all your eggs in one basket. Have a plan for how much you should convert, how long you should convert. If you're making contributions, make sure that you've funded both sides of the balance sheet so that you've got some money still in the future that you'll be able to potentially take advantage of the tax code and the way that it works at that time. Think about that when you're making your plan. Don't just blindly pay the tax to convert everything, because you might end up paying too much tax to do it. This brings to light that Roths are a complex topic. If you're looking for more information about Roths, click the Roth playlist. I'll put it right there. I'll see you next time.